What's happening, investors? This is the video log takes 30,000 to a million. I got some exciting updates from the trades today. And then I want to talk about how to close credit spreads efficiently, especially when you're dealing with a close that's near the strike price and or one of the wings is really far out of the strike price, and so you're having trouble finding sellers and buyers in order to exit your trade. It happens all the time, and if you just click on exit the spread, then you may never execute. So I'll show you a way that you can actually make that happen. I did not make this happen with the latest trade, and so I suffered for it. It cost me a total of $40, which is not insignificant. If you're gonna do a bunch of credit spreads this year, $40 per credit spread, that's quite a lot, right? So I'm gonna show you that, but first, I'm gonna go through the account, show you all the positions, all of the option positions, all the equity positions, the investment tab, and even relative performance. All right, I'm gonna go through it quickly. If you're interested in any portion of this, then you can click the pause button at any time to try to find out the exact positions, and then or you can just fast forward throughout the entire thing until I start talking about the closing out of the credit spread. All right, so first thing is first. Today I was down 1.42%, which is about on par with the S&P 500. Here are the option positions on the right. You'll see a lot of changes. Many option positions expired, which results in a buying power of about $170,000 that I can go in debt with right now. I'm only using $28,000 on margin at the moment, so my margin's historically very low here. So here we go. Option positions here on the right. Feel free to pause anytime. Not many of them right now. My positions are very thin. Not a lot of them. The ADRs were extremely disappointing today. The only one that's been really strong is VIP shops, VIPS. But unfortunately, I sold pretty much all of my VIPS a long time ago around this level. But it had a surprisingly good earnings, which I'm in no doubt they will. This company should be priced at least $20, but it's a foreign company, it's a Chinese company, and there's a lot of geopolitical risk and all kinds of risk going on with that, the listing risk, etc. So that's why it's priced about 50% of what it should be. So that's that. I have some YOLO calls on this company, about 6 of them. They'll expire January next year, which means they'll probably expire worthless. I doubt they're going to reach the $30 level at all. But if they do, I'll score, $500, $1,000, or a few thousand if I'm lucky. So, yeah, I've lost a lot of money on that. But such is life. So these are the option positions. Now I'm going to scroll down to the equity positions. I only have 5 positions right now. Apple, Realty Income Main Street, Paramount, and Smith & Wesson. All of them were down today. Apple was down almost $2,500, contributing to the massive, $3,000 loss I had today. But compared to the market, it's not that much. I think I did lose to the Dow. I don't know if I lost to the NASDAQ. We'll find out now. So the S&P 500 was down 1.43%. 1.34, so actually it did better than me at 1.42. Let's see how I did on the weekly basis. Negative 1.2 versus the S&P's weekly of, I'm using SPY as a proxy, of negative 0.71. So I'm actually losing on the week. Let's see how the market did on the 1 month chart. 7.73. I think I'm beating on the 1 month. Yeah, 9.71. So I'm beating by only 2%. So the market is closing the difference between, me and the market. The 3 months, I think I'm crushing it. Let's see, 3 months on the S&P. I'm at 29.55%. I think 7.25 only on a 3 month for the S&P 500. So beating by 22%. And finally, let's go for the 1 year. 1 year is minus 4.2. I'm also winning here. I am up 36. So about 40% difference between me and the market. Over 40% difference I'm winning on the 1 year over year. So very, very happy with that. And I would argue not with that much risk either. All right, time for the investment tab. Here I am with actually not an all-time low, I don't think. 23.66%. I'm not sure if that's an all-time low on the margin this year. Sorted by position, by total return, Apple, Realty Income, and Main Street Capital. Sorted by size, the equities are Apple, Main Street, and Paramount. So Paramount losing me a bit of money, but I am selling call options against it, so that's kind of neutralizing it a little bit. If you want to take a look at that position a bit more in depth, here it is. So Paramount's obviously had a rough year. I am selling options though. I still have about $240 to erase worth of liability. So far, I have $216 erased from my liability on these options. Let's see. I am down $3,400, so that's kind of a drop in the bucket there. But I have sold options before, and I will be selling some more. And I'm hopeful that the Paramount will return to like the $29, $30 level, at which I can exit happily, ever after. All right. So that's the accounts, and now I'm gonna move on to what happened here with the Smith & Wesson trade. So here's my positions. First of all, I have 1,200 shares, and the average cost about 50.63. I have sold a bunch of options on the way down, so I'm not doing too badly on this position actually. I sold a credit spread, call credit spread, and I've been trying to exit it. So if you go to the history, it was the credit spread was $15 call that I sold, and I bought the $17.5 call. I'll show you on the options wheel. But first in the history, these canceled trades, me trying to exit out of the position, which I didn't succeed in, and then Robinhood, as part of the option selling program, sold the options for me at a big lot, like not at the right price. Okay, so I could have exited at $50, but they exited me at $90. Actually, it would have expired worthless, so I would have gained $90 if they didn't touch the option at all, but I knew they would, and I failed to do something about it. So here's what happened here. Let's see. There you go. SWBI call credit spread. So I sold. Let me see if you can see this. Yeah. You may have to look at this on the computer, and it's probably going to be kind of hard on the phone, but I'll tell you what it is. I've sold 10 $15 calls, strike price calls, expiring on this Friday, today or yesterday, whenever you're watching this, on 8/19. And then I bought as a hedge 17.5 strike price calls, 10 of them, for a difference of about 20 cents per or $20 per contract. So that would be if it expires, if both contracts expired worthless, it would gain me $200. So that's the trade. And then what happened was, these $200, I was able, the Robinhood exited me at 90. So you see what happens is that they closed the $15 contracts at $10 per, which it should have been zero because Smith & Wesson ended up below a $15 level. So this $90 is really mine. They took it from me. But I could have mitigated the loss if I were to do what I'm about to tell you in a second. What I could have done is, instead of trying to close both the calls and the $17.5 call and the $15 call, what I should have done is just exit one of the wings. Okay, I should have just tried to buy back this wing here of the trade. Not wing, but this half of the trade here. If I managed to exit this contract at 5 cents, okay, which is the minimum basically that you can do, which means $5 per contract. I could have gained back $50, and instead it filled me at 10 cents for $90. So, you know, I'm not too happy about that. They also actually filled me at 1 cent here in the 17.5, but it's not worth, right? So that makes 100. That's why it's 90. It's 100, and then minus $10 here. I could have actually exited 50, and I could have let this one expire, or they could have auto sold it. I don't know if they would have auto sold it or not. They probably would have let it expire. So I would have been out, $50 instead of 90. Could have sold myself $40. So let me give you another example of what I'm talking about so you can probably grasp it a little bit better if I do a whole new trade and explain it that way, okay? So let's take Apple, all right? And you want to sell a credit spread on Apple. So you go to the options tab. You pick a date. First of all, always pick a date. Let's say August 26th. And the way you do a call credit spread is you sell a call, let's say above the strike price a little bit. How about 175? So you sell the 175, and you're going to need a lot of collateral for that. Okay? And look what it says here, max loss unlimited, right? Unless I have the shares to cover it. And max profit $84. And so in order to hedge that and not use up as much collateral, which is, it's going to want me to use 100 shares of Apple as collateral. And let's say I don't want to do that, or I don't have that amount of shares. Then what I can do to use less collateral is I can buy a call right above it, or a little further above it, depending on what I'm feeling like. Let's go right above. And you see what happens here? Max loss went from unlimited to only $200. Okay? Only $200. So my max profit is 51. My max loss is 200. And what I'm betting basically is that Apple is not going to go over 175, or if it does, it will go over just a little bit over 175, in order for the difference between these two contracts to not exceed the difference that it has right now, or the difference at the execution of these contracts. Does that make any sense? Like, for example, right now, the 175 contract is selling for 84. So let's say I'm able to sell this contract. I'm able to sell this contract at 80. Okay, let's say a little bit below the mark price here. Mark price is the difference between the bid and ask, right in the middle. So let's say I'm able to sell this at 80, and I'm able to buy this a little bit below, or a little bit above, at 35. So that makes a difference of $45. Okay? $45. And if Apple closes below 175, both of these contracts go to zero. Okay? So the difference between them is obviously going to bridge. Okay? It's not going to be $45 now. It's going to be, they're both at zero. So therefore, I get to collect that premium, that difference. Okay? Because I paid a lot less for the 177.5 contracts, and I sold the 175 contracts for a lot more, namely $45 more. Okay, so that's how the credit spreads work. So you collect the difference, okay, in premium. Now what happens is, if Apple closes above 175, it matters how much above it, right? So this contract might be worth not 84, but it might be worth $20, and the 177.5 might be worth, it's going to be worth zero, right? If, for example, Apple closes at 175.2 or whatever. So in that scenario, I still win, right? I still get $25 in my pocket. But if it closes a lot more, okay, if it closes all the way like at 177, for example, I'm not going to lose my entire collateral, but I'm going to lose most of it. Okay, because you know I'm going to have to buy back my 175 contract for whatever it's worth. It's going to be worth more, and I'm going to be, and my 177.5 is going to expire worthless. So I'm basically out. Okay, I'm out money. You see what I mean? If Apple closes at like some astronomical level, not 177.5, but like let's say close to 190, my losses are capped. And the reason my losses are capped is because my $175 contract and my 177.5 are going to be appreciating roughly at the same rate when it goes past this level, past 177.5. And so whatever I win or lose, okay, it's going to equal to each other. All right. And if Apple closes at 200 next week, all right, I'm only going to be out 199 because even though I've sold the 175, I've bought the 177.5. Okay, so even though one of them is appreciating, the other one is depreciating at the same rate for me, from my perspective. And they're all going to equal each other. All right, that's how it's going to work. So anyway, the tip of today, right, is if you don't have enough liquidity, let's say at the end of the week, Apple's closing around 175, and there's plenty of liquidity here for this contract, but in the last 2 hours or so, there's no one trading this 177.5. Nobody wants to touch it. So it's basically trading at a penny, and you can't find a buyer. All right? Nobody wants it because it's going to expire worthless in an hour. Let's say, for example. Or let's say you're trading at 180. It's less likely, right? So what you want to do is forget about this one. Forget about this contract and exiting out. Just take the loss of, like, let's say you do 10 contracts. Take the loss of that $10. And don't worry about it. Just let it expire worthless. Just dig at this 175 contract and see if you can exit that one, because that's the one that's important. So set a limit price. Keep working the trade of only this swing in the contract. Don't try to close out the entire credit spread together, okay? Because that will never fill, because the top part will never fill. So you want to just pick the bottom part, fill the bottom part, okay? And just exit that side of it. Because you don't want the Robinhood to try to exit the trade for you, because as you see, they don't give you good pricing, right? They'll obviously screw you. They'll like hit all the bids, and they'll hit a bid it suits them but not you, right? So it'll basically just screw you out of your money. So you don't want to do that. Okay, only deal with one side of it. So I close this one first, ignore the top. Okay, that's the basis of what I want to say here. So if you want to save yourself some money on your, credit spreads, then that's what you want to do. If you have any questions about it, I want to answer it. Also, I have a question for you guys. My question is, because I've been looking on the internet about level 2 options data. I don't know if level 2 data that's displayed on Robinhood and other brokerages, I don't know if that includes like option. I assume it doesn't, because the numbers seem really low. So what I want to know is bid and asks level 2 data that goes deep on the different levels of the bid and ask for particular options contracts. I'm looking for that data, and I want to know where to find it. So if you guys have any tips on where to look for that, please let me know, because I want to improve my trading. I want to improve my methods, and I've been digging around. I can't find anything yet. So if you do know, please comment below, and so I can dig it up and find it. I'll be very thankful. All right. With that said, I'll hopefully make another company video over the weekend if I have time. If not, I'll see you next week. Peace out.